Hi, good morning, everybody. Thank you for joining today's Winter Outlook webinar with AIC. I'll have a slow start in case there are any people joining late, like this one. Just let someone else in. If we just skip to the next slide, John, I'll just quickly go through some housekeeping first. So the session's scheduled for 45 minutes. It'll last around 35 minutes for the presentation, and then we'll have a little time at the end for any questions that we might have. All the microphones are muted and the cameras are turned off, but there is a Q&A function at the top of the screen, so that's assuming your Teams looks like mine. So please use that throughout the presentation. More questions we have, the better. If we can answer a question straight away, and it makes sense to do that because it fits with the flow of the presentation and because it isn't covered in the later slides, then we'll answer it straight away. Otherwise, we'll answer it at the end. And if we don't have an answer straight away or we run out of time, then we'll come back to you directly after the session. The session is being recorded and a video of it will be made available to everybody. You've skipped past the disclaimer, John. So I was just wanting to say, as far as well, as I'm sure you all already know, and will be made clear throughout the presentation, energy markets are volatile, influenced by lots of factors, and they're all outside of any of our control. So there are no guarantees within the presentation of what's going to happen, nor is there any specific advice of what you should do. One, because no one knows the future for certain, and secondly, because you'll all have your different situations, requirements, and risk appetites to take into account for your particular procurement strategy. So I would say, though, that AIC are in the 50th year of successfully supporting organisations with energy-related challenges, like buying from the volatile energy market and coming up with bespoke strategies to help meet specific requirements. So although there aren't any guarantees, we do have a lot of experience in successfully supporting organisations to navigate the market risk and achieve procurement objectives. So just before we get into the introductions, this is the agenda for the session today. The objectives are pretty much as was the invitation that you'll all have seen. We're going to be going through the market drivers, things that are influencing the prices as we move into the winter period. We'll explore the risks and the opportunities, just to give a bit of context and information for the decisions you'll make around your own procurement strategy. And then we'll look at how you can use the information to achieve your specific requirements. And then lastly, we'll look at the next steps and any questions that might have came up. So for the introductions, my name's William. I know from the attendee list today that quite a lot of people will already know me. I've already spoken to quite a lot of you, but I'm from the sales team at AIC. I joined back in 2010 and I've had the pleasure of working with lots of organisations as part of the account management team and as the sales team, many private sector organisations and public sector organisations looking after lots of different requirements and lots of different market conditions. John?
Yeah, John Dawson here, energy trader and market intelligence manager. I take care of I cover both the energy trading desk and the market intelligence service. If some of your customers here, you'd have got reports that are covering the markets on a daily, weekly, and monthly basis. I've been with EIC over about 11, 12 years now. That's it.
Thank you. And then I think it's oh, yeah, of course, AIC, who are we? So most of you should already know who AIC are, so I'll make this quick. But the AIC partnership is an energy consultancy with a long history and track record of providing energy-related solutions. Business was built on the back of market intelligence and procurement solutions, but it's evolved over time to meet demand. So you can see we do a lot more stuff now, but the market intelligence and the procurement solutions remain an integral part of what we do because prices are significant, markets are volatile, and getting it right makes a massive difference to the organisations that we support. So it's still a very important part of what we do, which is why I guess we're here today to talk about it in a bit more detail. So I'll be quiet now for a little bit, and yeah, if you want to take it away, John.
Thanks, Billy. So over the next couple of slides, or several slides, I should say, we're going to try and paint a picture of what to kind of look out for or what may happen in the market that may have an influence on price. A lot of it will be fundamentals because there's a lot of other things that we can't really quantify, but we will try to explain more in detail as we go through the slide deck. So we'll start off with looking at UK gas demand. This graph in particular shows the summer and winter cycles that we see over the last 4 years. So when we do have the summer periods, we get a lull in demand, and over the winter, we obviously get an increase in demand, and the cycle continues uh, um, as we go over the years. Now, the last two winters, they've been mild in comparison to historical levels. Global temperatures are elevated for various reasons. At least some of the meteorologists believe there are some reasons for that. As we go into this winter now, the expectation is that overall temperatures, global temperatures, will still remain elevated compared to historical levels. But we will obviously have periods where there will be cold snaps. The last two winters had really short and sharp periods of cold spell. They didn't last long. Most were a few days, or maximum a week. And they happened earlier on, with a lot of storage supply still available and a lot of LNG available for those for those two winters. We always go into the winter with an unknown demand sort of scenario. We can never really quite tell what sort of weather we will get, but there are certainly influences that will have an impact. If those cold snaps are particularly longer lasting, maybe some of you can remember Beast from the East, those kind of situations, but combined also with what kind of supply picture we have available at the time, it's that combination that can have an impact on price, or at least on sentiment. If we were to have a cold spell with a very low wind availability, it does mean a higher need for gas, for instance. If we have, an extended cold spell, but an outage on supply front from, say, Norway, that will have an impact. Those are usually price risks to the upside. But for prices to drop, we could have quite a lot of wind availability through the winter, and that eases the need for gas to fire generators. So there can be positives and negatives, but it's always an unknown element as we go into the winter. And because of that, the winter price is always the highest because the demand is higher and the unknowns are higher. The risks then become elevated. On the supply front, we have various avenues or routes to reach the gas, or the gas to make its way to the UK. The ones that are base load are more like Norwegian supply and UK continental shelf supply. These are the bread and butter of the supply routes that we have. As long as they stay stable, without much interference, without unplanned outages, the baseload supply is strong, but it isn't enough to meet winter demand. For that, we've got to rely on other flexible routes. So we've got a LNG, liquefied natural gas component, that is of extreme importance. And we also see storage top-ups during these cold spells. Okay, so as long as pipeline supply remains stable for most of the winter, it is the LNG and it's the storage that helps to facilitate or smoothen the ride, as it were, through the winter, especially when those cold spells do arise. So they'll be the primary focus of our webinar today, because that's where we think some of the risks particularly lie as we head into the winter. Liquefied natural gas is extremely important now to the market, especially in the UK and Europe, because obviously we all know that Russian pipeline supply has obviously ceased for the most part, and as a result, Europe has had to pivot towards LNG as a source of gas. No longer is a pipeline supply, which prior to everything kicking off was quite a constant, secure supply of energy, of gas, particularly to Germany, and also historically at kind of cheaper levels. Now, liquefied natural gas has ended up having to be a substitute supply, which implies more competition because as a product it is used worldwide. And equally, if you are you're now looking at market prices, prevailing market prices in order to satisfy demand. So LNG is an very important component of supply. And with it, it brings its challenges. This looks at the quarterly supply of LNG over the last 4 years. The notable bumps are obviously in 22 and 23 when, as we're going into 22, we had obviously all of the 21 into 22, we had all the issues restart as far as the Russian supply was concerned. And 23 was basically the market pricing in LNG into the future, wanting to secure supply. So there was a bumper increase in volume over those years. But what we have to notice now is that in 2024, we did have a dip in supply, and very notable in Q2. Q3, we always tend to see a lull in supply. The question mark now obviously is going into the winter. What kind of volume will we get into Q4 into Q1? Because usually that's the more pertinent supply. As we've highlighted, flexibility and as far as supply comes from the LNG. This drop in supply over 24 has been, like I said, quite notable. And the risk is obviously that the volume remains on the lower side as we head into this winter. Okay, its importance is elevated, but the volume is now decreasing comparative, obviously, to the high-priced environment that we had over the last 2 years. So the market appears to be given a signal that the LNG is not necessarily needed as much at this point anyway. But there's also other reasons for it, which I'll come into the next slides. But just remember that the volume has turned down this year so far, and as we go into the winter when demand is elevated, what kind of supply will we get? There's also other issues with LNG, and it comes around this Russian LNG. Europe does receive Russian LNG as it stands. So while pipeline supply has ceased, there are no sanctions as yet on Russian supply of LNG to Europe. The EU has taken a stand where it has, over the course of the next few months, I think going into the summer of next year, any Russian LNG that goes into Europe that is then transshipped to Asia will cease. But that's a positive because it does imply that Russian LNG will be made more available within Europe. So it's a bit counterproductive in a way of trying to seize or reduce the cash flow for Russia. But it does mean that Europe will take up whatever should have gone to Asia will probably end up in Europe. The only escalation at some point, which we can't yet time or see, but it's inevitably going to come at some point. There will be sanctions on Russian LNG going into Europe, but Europe doesn't have a strong footing at the minute to obviously escalate this further. So for the time being, there should be enough Russian LNG supply into Europe. But there are voices growing within all those countries that obviously don't take this LNG, that Europe should cease taking Russian LNG to, obviously for political reasons. But those with higher power as such within the bloc are not going to necessarily jump into that particular discussion at this point in time. Not until they have a strong hold on alternative supply. But it'll be one to watch in the next couple of years as to what happens. Now, this chart shows price differential between the US TTF and Asian price. So it's mostly the relationship between the orange and the blue. The blue being TTF, which is a Dutch price, which is basically a benchmark for European pricing. And the Asian LNG, this is the forward price. So the key takeaway here is that US producers, in US, the price is down here. And you can obviously tell there's an incentive to sell product to Asia and Europe. Now, the incentive and the margin is there and the profit is there. So hence as the US is trying to send as much LNG as it can to Asia and to Europe. The difference in price between these two at the minute, it is the Asian price that is above the European price. So the market is at the minute giving a signal that Asia wants more of that gas as it stands, and Europe is holding back. So that kind of ties into why in 24, so far we've seen that Asia has a higher price compared to Europe and UK. Hence why we've seen fewer cargoes arrive in 24 so far. And if we look into winter and into next summer, it's still the same relationship where the Asian price is above the European price. So as a forward signal, any US producer at the minute is incentivized to send it to the higher price market. Obviously, this is not yet looking at cost of shipping, but as a price signal, wholesale markets are implying that Asia is still willing to pay a higher price. So if we are seeing less LNG coming in, and the forward price is implying that there could be a situation where we have still less of it, certainly compared to the last 2 years. If, for whatever reason, the UK market and European market needs more LNG, there will be stiffer competition. European price will have to get above Asian price and stay elevated in order to incentivize those US cargoes, those spot cargoes to come to the UK and come to Europe. So again, I'll reiterate that point is that the market has put itself in a position where it's saying it doesn't need the LNG right now and therefore it's discounted compared to Asia. But if a situation comes to market, it could be Norwegian turned down in supply for some reason, or a higher need for gas, either be it because of an elevated demand, weather-related demand through the winter, or a drop in some other supply side, be it nuclear or something else, or very low wind, and there's a higher need for gas, certainly for an extended period of time, there will have to be a price push up. Prices will have to, the market will have to compete against Asia, and if they still need it more, that competition could see an equal rise or such before maybe European prices go above. But as it stands, the market doesn't think that's the case as for now, but it's put itself in a position where it will have to compete for it. The other issue with LNG, courtesy of this graph from ISIS, is the LNG is a global product. So in the US, it's a major producer, as is Australia, as is Qatar, and some pockets of South America, and sometimes as well in West Africa. But the idea of showing this is the fact that the product has to be shipped from one place to another, and obviously it's got long distances to travel. So at the minute, there are these bottlenecks that have, say, popped up this year. When it comes to the Panama Canal, it's to do with drought that have affected the water levels, because there's a stair-step system that they use there in order to allow for the vessels to pass through. But that source of water is a lake in the region, and if there's a drought there, then the water levels drop. Then you can't utilize the canal properly, and that's caused an issue. Equally, when we're looking at the Straits of Hormuz, or getting into the Red Sea and using the Suez Canal, we've obviously all read the stories. When you have the Houthi rebels launching rockets at ships, it's prevented cargoes using a much shorter route to travel to other markets. So from a source to a demand area. As a result, the Qatari cargoes that we'd usually get can't necessarily go through there. They've had to go right round through the Cape of Good Hope. And US supply to Asia can't necessarily take this route through the Suez. And if they have to, they'll have to use the Cape of Good Hope as well. So it does create a logistical problem. Once in a while, you've probably heard why, Australian LNG strikes have happened, production can't, ceases or whatever. then Asia can't get any cargo from Australia, so it has to look from somewhere else. So Asian prices go up compared to, say, to Europe, and the Qataris then send the cargoes to Asia instead. So we're it's making the gas market, although wider in scope as far as different continents concerned, but it's bringing us closer in a way because it's making it a much tighter market, a much closer market, a much more interlinked market. Things that happen across the globe have an impact or ripple effect on everybody else. Now, storage is very, very important to the market. European storage is extremely important, not only for Europe, but also from a global perspective. The infrastructure in Europe is very mature and of a very large scale. The amount of gas that's either in there or not in there at a particular point in time has an impact on price, an impact on sentiment, and what people, the market participants, feel price should be at. In at the end of the last two winter cycles, we've seen a lot of gas remain in store, but that's as a consequence of two mild winters and a lot of liquefied natural gas available. So a lot of supply, and compared to the demand that we ended up having, it exceeded that. So a lot of the gas that was in European storage was underutilized, and we ended up with, two winter cycles with a lot of gas to store. More so at the start of this summer. At 59, 60% full, it doesn't take a lot to fill up that 40%. But is this underutilization that had an impact on price and helped the decline in price since the shocking rises that we had seen? The underutilization of storage implied lower summer pricing because those who need to refill the storage don't have as hard a task to refill. That makes sense there. It's if you've got more in tank at the end of the winter cycle, you've got less need or less requirement to refill. If Europe was to utilize quite a lot of that gas in store as it did in 21, the 2021-22 cycle, then it's a much harder task, it's a bigger ask to refill storage. Now, these things always happen. We'll use it and we'll refill it. But it's more of a question of if in this particular cycle we use quite a lot of that gas, and LNG there's more competition for liquefied natural gas, and it's a tighter market per se because there is less, obviously, Russian supply in totality. The market will view if that more of the gas is used, it's a higher ask to refill this. But equally, in the process of refilling, will there be enough gas around through the summer to fulfill that? If the forward pricing on LNG, as we saw, implied that Europe is below Asia, if we were to get to this situation, it's likely that European prices would have to go above Asian price to incentivize more LNG to come so that storage can be refilled. But equally, if it's underutilized again, then it's more likely to put downside pressure on price. Because the need to replenish in the summer will be easier, and it implies that the ability to get to full by the start of winter the probability is higher. So how storage ends up at the end of winter will be an important tell for the market. Now, the market can decide that, over the next, by the end of this quarter or into next quarter, as to how it views extrapolating how that storage will look like by the end of March. It did that last year because in November that's where the prices dropped dramatically, and it was off the basis of where storage looked like it was going to end up still quite full. And that's why there was an acceleration lower in prices in November last year. Now, there is obviously some government intervention as far as EU storage is concerned, and that's to do with security of supply. So they're mandated to be at certain levels at certain points. By the 1st of November, they're meant to be at 90% full, and they're already above that for now. So we're slightly below last year's levels, but still is kind of record levels. So at the minute, the way storage stands, it's a positive for the market in the sense of that there is a security of, there's a bumper resource there required if needed. What is not known is how it's going to be used, if it's heavily used or not. And unfortunately, that has to be a journey through at least Q4 to kind of determine how we'll end up at the end of March. This shows a power generation, what makes up power generation. So, you know, the UK doesn't use coal anymore, but we've got biomass, nuclear. We get imports from Europe and gas-fired generation, and then we've got renewable, mostly wind generation in this particular instance in this graph. So wind generation obviously is quite important. It's ever exceeding in capacity. So it has a positive influence and sometimes a negative influence on price. You know, sometimes it blows too much and we've got too much availability. The gas switches off at times. You can see at this particular instance where it's just all of that supplies, most of that supply is coming from renewable generation. So wind, as far as its availability is concerned, it's of importance. When we have periods where there's a lot of gas that's come on because there's very low wind, it implies a higher gas demand from the power sector. So wind availability, and because it's the capacity is increasing, its influence on price kind of makes prices swing around a little bit, certainly on the day ahead on the prompt pricing. But its effect over the course of winter is also felt because if there is less wind per se over the over the winter, it implies more gas would have been needed, and vice versa. If we do get storms, if we do get high wind speeds over the course of winter, less gas is needed. So it's that relationship between the two that's quite important. We do get a lot more wind over the winter period, so its availability in a sense kind of dampens demand. But again, the weather system that comes kind of dictates that. Unfortunately, it does mean when we do have those high pressure, cold situations where I guess it's clear sky, barely any wind, you know, that's the time you need more of it when it's quite chilly in that respect. And it's also if we do get those extended periods of cold like that with high pressure, that the wind wouldn't be around to necessarily help, and we're going to have to rely a lot more on the gas. Equally of, I should say, really major importance is French nuclear power generation. French nuclear power generation is like at 62 gig when our peak demand's at 35 gig. So there's a lot of French nuclear availability, and they have an excess that they tend to export out to neighboring countries, and we're also linked to France as part of this import calculation in here. Now, they need to have stable supply because if they do, they're able to send that excess to everybody else. If they have an issue, they tend to then insulate, and everybody else has to figure out how they're going to replace that. Now, in 2022, just in the middle of all the crisis of a lack of gas, there was also where they had French nuclear generation had to be turned down because they had to go and do some inspections and check safety of equipment. And this will always be an overhanging risk as we go into the winter. There's stable supply now. There is a forecast for an ever increasing supply of that because a lot of the assets are coming back. And here you can see 2022 there was quite a little availability. But we've got the stark contrast going into Q4 of 24 and forecast for 25 implies even more. So there's assets coming back. Those have to be stable. So the market participants can see this forecast from EDF. The question then will be, or the risk rather, is something that is totally opposite to this outlook. So if there's any wobbles as such, it's going to bring volatility to price. It is very important as far as a source of energy, a source of power to Europe. And if they have any issue, it has a ripple effect on everybody else. So next couple of slides, we're going to look at market prices. We're going to look one at very historical pricing. This is going back, to 2004 to kind of present times. We showed this slide deck back in webinar in July. I think it's still pertinent to kind of show this because gas prices have sort of been between a 30 pence and closer to the hundreds as a range, and it was a crisis that kind of blew prices through that 100 to get us to extremely elevated prices, which have since come back. But we've got to recognize that the market has changed as far as the gas supply dynamics are concerned. The not having Russian LNG, certainly its consistent supply at a decent price level, we're now having to pivot towards another source. And like we said before, it's the LNG. And like you said, the LNG demand globally is increasing. LNG supply is going to step up as well with new projects coming online. But it's a different price, it's a different market dynamic without having the Russian supply. So the market's going to have to assess whether this pivot to LNG, does it require us to be in a different price range? And that's the question asked about this price chart. Whether this will end up just being a blip that we had through 22 and we come back inside the range that has been the normality for certainly since 2005, or whether we stay elevated above 100 for a while. Okay, I don't have the answers to that right now, but it's just one to kind of at least have at the back of your mind. Power prices as well were in quite a range since 2005, and the crisis obviously broke out. So price breakout, and we've come back to that range and found support back in February, March. Again, it's the same question. Are we out of a the way supply and the supply fundamentals versus the matched up against the demand fundamentals, did that kind of cap prices where they were? Coal prices would have been important in as far as a deterrent for higher prices, the relationship with gas and power, because if gas got too high, more coal would jump in, but now we're taking coal out of the equation. So, the market dynamics are shifting, and they are the things that kind of dictated to a large degree maybe where the bottom of prices or where the top of price was. But we're taking certain things out of the equation, and so does that change things going forward? Okay. This is something we'll have on our slide decks going forward for the foreseeable future, just to track and see where things, how the lay of the land is still dictating price. But now we're going to focus on the more shorter term. Looking back at this February low, we've got two situations here. If we just think back to last summer, we were in a sideways market as the market was kind of waiting to see what sort of weather we would get, what sort of demand we would get, how storage would be utilized. And you remember me saying in November, the prices dropped, and they dropped because a lot of gas was left in store, as there was also a lot of LNG coming. So it's people taking the bet that, we've got quite a lot of supply, we've got quite a lot of gas here. It shouldn't be priced this high. And so we had the sort of collapse in price. But So come March, is the market had to backtrack that because the LNG didn't turn up as much as as people thought it would over the last 2 years. So the supply dried up, the storage overhang that we had in Europe, we were above the previous summer, uh, and we couldn't inject at a similar rate. And so the excess over and above what we had the previous cycle got eroded. So the market kind of recovered. What we've done is gone through this summer again in a sideways market. However, it has to be said with a lot of volatility for various reasons. One being the latest one, I think, was to do with the Ukrainian Russia situation, the Kursk region, affecting, in the Sudza town where there's this pipeline that there's gas transiting Ukraine. Again, that's another topic altogether. But the market has been sideways since. I guess now it's more of a question again, harking back to the behavior that we've seen back here in going into Q4 of last winter. It's that question mark of, yeah, how much gas do we think is going to be left in that storage? If a lot of that gas is utilized, certainly earlier on in the winter, then there is a chance that maybe we do see some upside price risk, especially if the LNG situation remains tighter as it is. But a mild situation, of course, would then imply there's a lot of gas in store, and maybe that as well would cause prices then to drop. Now, a sideways market, it's not trending. It's not moving neither up nor down. So there is going to be a break at some point. The fundamental picture is that the market is tight. There is a lot of less Russian LNG available. We're relying a lot more on LNG, and we're relying a lot more on Norwegian supply. So if there's any issue on LNG or any issue on Norwegian supply or any issue on French nuclear generation, that will be upside price risk. But if we have a mild winter, a lot of gas left in store, or we do get a situation where there is, I don't know, like a macro situation where I guess the markets see more of a downturn in economic downturn as such, the sentiment will then weigh on price, and we'll see that drop down in price. Right. The other thing to note as well is that summer 25, for instance, is well above summer 26, and winter 25 is above winter 26. So the prices further out are lower than present. So that implies that the market is seeing risk in the near term, hence the elevated price versus the prices further into the future. So that implies that the market is still seeing risk in the market because of the shape of the curve. In normal terms, near dated is lower than further dated, and you get that's a normal distribution. But at the minute, at this point in time, there's elevated prices on the near term, and that implies the market is seeing some potential stress, and a premium is asked. Power prices as well, sideways for this summer, and for the reasons I've said on the gas, it's quite it's more of the same here as we look at power. We will either get a push up or push down. Sideways market, we can't quite tell. Something will have to come in that will dictate how participants will have to respond to that. A short-term bias is that, for instance, if the winter 25 was to go below the 80, then there's a potential that we get lower. But at the minute, there is no fundamental reason for price to be in a sustained downtrend or in a sustained uptrend. The market is in a wait and see approach at the minute. And just like the gas, this market is in backwardation, so the longer dated prices are cheaper than the closer dated contracts, seasons at least in this case. And again, it's for the same reasons. The market is pricing in risk and seeing a tightness, so it is demanding a premium at this point in time. The carbon market is quite important when it comes to the power market. but here there is no signal as such. We can see the weakness that there has been in the in Europe and certainly in the UK. I only bring this up because if carbon prices were to start to recover here, and if EU prices will start to go back towards the 100, and UK prices start to stabilize here and push up, that will have a ripple effect on power pricing because it implies a higher tax for generators. So they would want to front run that and secure the power now, because if carbon prices are higher, it will cost more to do so. So they will be front running the power market because the cost to produce that was going to rise in the future if carbon prices were to bounce up from here. And equally, if carbon prices do drop here, then it does weigh down on power pricing because the cost burden is reducing, so the power price will drop in as a result. Or even if gas prices were to rise, the power prices wouldn't be as strongly incentivized to do so because this element here is still weak. So carbon is important from a pricing mechanism or price discovery for power. And if I go back to power, actually, one of our challenges is pricing. The liquidity is quite poor. Certainly for longer dated, if you're looking at summer 26, winter 26 pricing, there can be pockets of illiquidity there where you can't get pricing from suppliers, certainly those who do not have any asset, not asset backed. And so sometimes that can be a challenge, especially if the market is going through some volatility in the gas side, the power side will dry up as far as liquidity is concerned. So if you do hear from some people saying, I can't find a price, it is part of the situation when it comes to power. It's a bit of a challenge. So just as a summary, these are the key winter risks. It's something that's going to affect demand, will affect liquefied natural gas, will affect EU storage. The one I didn't mention in particular was when it comes to Russian gas, when we're looking at Ukraine transit agreement, that ceases this year. The two parties are unlikely to come to an agreement by the end of the year. So this would affect gas that was making its way to Austria, Hungary, Slovenia, more Central and Eastern European market. But it's the way it would affect sentiment in the wider scheme of things. We did see a story come out in mid-September that there was a solution found to this, and we did see the market react to that news. And since then, the news got they had to turn around on that news because the information was incorrect, and then we've seen the price rises as a result of that. So that's going to have some short-term implication on price as far as a swing in sentiment. But also we've got geopolitical risks further abroad that may have an impact. One, we've seen the LNG flows certainly through the Suez Canal being impacted. But also if we have rising crude prices, they'll have an impact on those LNG contracts that are linked to oil. So if oil prices go up, we'll see some costs going up for those particular contracts that are LNG contracts that are governed by that indexing to oil. And also another important one is the positioning in the market. When you've got hedgers versus the speculators, depending on how something comes to market, if speculators are caught on the wrong side, they do cause quite a lot of volatility to come to market. I guess the biggest example of this would have been in the crisis.
John,
the price. Yep, almost done in time.
Yeah, it's 45 minutes. Yeah.
Okay, so just to finish, speculators, how people are positioned in the market will have a major impact on price as well. Because if things come to market at the wrong time when a lot of money is on the wrong side of the trade, it causes prices to shift because they have to unwind that position. And that money those positions have to be turned around, and that's both upside and downside. So they do have an impact on price and price discovery.
Well, thank you very much, John. We've used all the 45 minutes that we'd planned, so I won't go through these slides in any detail, but we'll reach out to you all individually if you'd like to have a chat about stuff, and we'll get into it more then. The only thing I'd say, if you want to skip forward to the next slide for the next steps, John. So the recording will be shared. We have more plans for market intelligence to be provided. Obviously, if you're a client, you already will get lots of market intelligence from us. But we'll be having monthly updates on the website, so keep an eye on those. And we'll have another webinar in 6 months' time, moving into the summer. If you have any feedback, well, we'll reach out to you, provide any feedback that you can to the session, and make any suggestions on other stuff you'd like us to cover, please. And if you need anything else, then just let us know. But sorry that we overran a bit, but hopefully it was all worthwhile for you, and thank you very much. Excellent. We'll leave it there. Cheers, John.
See you.